Hello and welcome to Mkoya Finance. My name is Zaradine and I'll be your finance tutor in this class. Today, I'll introduce you to two new terms that are frequently used to measure the performance of a company, which are return on assets, also known as ROA, and return on equity, also known as ROE. So let's get down to it. As we know, every legitimate business operates to make profits. But how do we determine if a company is making good enough profits? In other words, how do we determine the performance of a company? One way is to look at the company's net income and see how much profit it made. But that doesn't really tell us much about how well the company performed. For example, if I use $100,000 to buy an oven and start a pizza company at the beginning of the year, and after 1 year, the company made $10,000 as profit or net income, can we say that the company performed exceptionally? What if the same type of company was set up in the same location with $200,000 which was used to buy 2 ovens, and the company made $18,000 profit or net income by the end of the year? So what can we use to compare the performance of the two companies? Is it the net income? We can see that the second company made more profit compared to the first. So which of the two companies would you invest your money in? One simple measure that we can use to compare the performance of the two companies is return on assets, which is a ratio that tells us how profitable a company is in relation to its total assets, that is, its liabilities plus its equities. It also gives us an idea about how effective a company is in converting the money that was invested into profit. Return on assets is expressed as a percentage by dividing a company's net income by its total assets. Remember from my income statement video that net income is the total amount of income minus expenses including taxes that a company generates for a given period, and total assets equal total liabilities plus equity. In the case of the first company, the return on assets is $10,000, which is the net income, divided by $100,000, which is the total assets, and we get 0.1. Now, because return on asset is expressed as a percentage, we multiply this by 100 to make it a percentage, and thereby have 10% return on assets. For the second company, the return on asset is $18,000 divided by $200,000, and our return on assets is 9%. These two results show that the first company was better at converting its investments into profits compared with the second company. So if you're investing money, it will be more profitable to invest in the first company because you will get a return of 10% on your investments, while the second company will only give you 9%. In other words, if the first company had started with $200,000 or 2 ovens instead of $100,000 or 1 oven, it would have made $20,000 profit, all things being equal. From this example, we can see that the higher the ROA number, the better, because the company is able to earn more money with a smaller investment. In finance terms, we see that a higher return on assets means more asset efficiency. On the other hand, a lower return on assets indicates there is room for improvement. ROA of companies can vary substantially depending on the industry in which they operate. For example, a company that is into construction will have large amount of assets compared to a restaurant. When assets, which are the denominator, are large, the ROA tends to be relatively lower, while when assets are small, ROA seems to be bigger. So the return on assets of these two companies won't necessarily correspond, and comparing them can be misleading. Therefore, when we use ROA as a comparative measure, it is best to compare it against the same company's previous ROA or that of a similar company. Sometimes, however, we can increase assets during the accounting period. For example, in our pizza making business, while we started with 1 oven worth $100,000, we might decide to buy 3 more ovens during the period. One in the month of May, making our assets $200,000, another one in August, making our assets $300,000, and a third one in October, making our assets $400,000. The normal convention is to use net income at the end of the period divided by total assets at the beginning of the period. And this shows us how much profit the assets that we had at the beginning were able to generate at the end of the period. Because 3 more ovens contributed to the profits made at the end of the year, here we cannot use beginning assets, which is the cost of only the first oven. Additionally, the second oven contributed only to profits made between May and December. The third oven contributed to profits made between August and December, while the fourth oven only contributed to profits made between October and December. So, which value of assets do we use? Do we use the beginning assets or the ending assets? In reality, different conventions are used, but the most common convention is to take the average by adding assets at the beginning of the period to assets at the end of the period and dividing by 2. The beginning and ending period should coincide with the period during which the income was generated. In the case of our example, we will have $400,000 plus $100,000 divided by 2, and therefore our average total assets will be $250,000. So the question now is, what is a good return on assets? Generally speaking, a return on assets of over 5% is considered good and over 20% considered excellent. When return on assets of a company rises over time, it indicates that the company is doing well at increasing its profits relative to total assets, while a falling return on assets indicates that the company's assets have failed to produce profit growth, which is a sign that the company may be in trouble. In summary, whether you're a business owner, a potential investor, a finance professional, or just someone who is interested in understanding the performance of a company, you can use return on assets to determine how efficiently the company uses its assets to generate profits. However, return on assets shouldn't be the only determining factor when it comes to making your investment decisions, as it is only one of the many metrics used to evaluate a company's profitability. And this brings us to the end of this video segment. The next common metric is return on equity. If you have learned anything new about finance today, please hit the subscribe button and follow my channel in your quest towards becoming a finance expert. See you in the next video.